In the early 2000s, Valeant Pharmaceuticals looked like one of the greatest success stories on Wall Street. While traditional pharmaceutical companies spent years developing new drugs, Valeant had discovered a much faster strategy. Instead of creating medicines from scratch, the company bought existing drug companies, acquired their products, and looked for ways to make them more profitable. The idea was simple: buy companies, cut costs, increase earnings, then do it again. And for a while, this strategy looked unstoppable. Valeant began buying up pharmaceutical businesses at an incredible pace. Every acquisition made the company larger. Every quarter brought more growth. And investors started believing that Valeant had discovered something other companies couldn't: a way to grow faster than the entire pharmaceutical industry. Wall Street loved the company. Analysts praised its aggressive strategy, and investors who got in early made enormous returns. At its peak, Valeant became one of the most valuable healthcare companies in the world. The company was worth nearly $90 billion. But the person who became one of Valeant's biggest believers wasn't just another investor. He was one of Wall Street's most famous billionaires. His name was Bill Ackman. Bill Ackman had built his career by making huge bets that other investors were too afraid to make. He wasn't interested in following the crowd. Instead, he searched for companies he believed Wall Street had misunderstood. And when he found an opportunity, he wasn't afraid to invest billions. This strategy made him famous. Ackman became known as one of the smartest and most confident investors in the world. So when he looked at Valeant, he saw something special. Ackman believed investors were focusing too much on Valeant's aggressive strategy and not enough on its potential. He thought the market had underestimated the company. And in 2015, his investment firm, Pershing Square, built a massive position in Valeant worth billions of dollars. For Ackman, this was more than just another investment. This was the kind of bet that could define his entire career. If Valeant continued succeeding, he would look like a genius. But if it failed, the consequences would be enormous. And at first, everything seemed to be going exactly as planned. The stock price was rising, the company was growing, and investors believed Valeant could continue its incredible run forever. But behind the success, problems were beginning to appear. The first warning signs didn't appear as a sudden collapse. They appeared slowly. Small questions, small concerns. Things that many investors ignored because the company was still making money. But some people started questioning how Valeant was achieving such incredible growth. Unlike pharmaceutical giants that spent years researching new medicines, Valeant depended heavily on buying other companies. And to keep expanding, it needed to continue making more acquisitions. That meant taking on enormous amounts of debt. The company was growing quickly, but so was the pressure. Then, Valeant faced criticism over its pricing strategy. The company had raised prices on some of the drugs it acquired, arguing that it was improving the businesses it bought. But critics argued that Valeant's growth was becoming too dependent on increasing prices rather than creating genuine innovation. Then, in 2015, a report raised serious questions about Valeant's accounting practices and its relationship with a specialty pharmacy called Philidor. Suddenly, the company that had looked unstoppable started looking very different. Investors began asking a dangerous question. Was Valeant actually as successful as everyone thought? Or had Wall Street fallen in love with a story that was too good to be true? Once confidence disappeared, Valeant's downfall happened quickly. The stock price that had once seemed unstoppable began collapsing. Billions of dollars in market value vanished. Investors who had once praised the company started abandoning it. And for Bill Ackman, the situation became a nightmare. His entire investment was built around the belief that Valeant was misunderstood. But now, the market was questioning everything. The company's debt became a major concern. Its business practices came under intense scrutiny, and the stock continued falling. Ackman publicly defended the company and argued that Valeant could recover. But investors were no longer convinced. The company that had once been Wall Street's favorite became one of its biggest disappointments. Eventually, there was only one option left. Pershing Square had to sell. In 2017, Bill Ackman exited his entire position in Valeant. The investment that was supposed to become one of the greatest successes of his career had become one of the most painful failures. The loss was around $4 billion. The Valeant collapse damaged Bill Ackman's reputation more than almost any investment before it. For years, he had been known as the investor who could find opportunities nobody else saw. But now, critics questioned whether he had become too confident in his own ability to predict the future. Valeant wasn't just a failed investment. It became a lesson about the dangers of believing a perfect story. Because when a company is growing rapidly, investors often focus on what is happening above the surface. They see rising stock prices. They see increasing profits. They see success. But they don't always see the risks building underneath. And sometimes, the biggest disasters don't happen because nobody saw the warning signs. They happen because everyone saw them, but believed the story was too good to fail.